So a lot of what you're hearing today is interest rates climbing, climbing, climbing. And who's responsible for that? Well, it's the Federal Reserve. And so you're probably asking yourself, well, what is the Federal Reserve? That's what we're going to get into today. So the first thing is, well, how is the Federal Reserve created? Well, check this out, right? The creation of the Fed, prior to the Federal Reserve, banks were decentralized and unregulated. If one bank ran out of funds, it could incite a panic and cause a run on more banks. After the financial panic of 1907, the Federal Reserve System was signed into law by President Woodrow Wilson on December 23, 1913, to stabilize and build trust in the American dollar. Well, what does that mean? Back then, what could happen is if a bank didn't have money, people would panic. They would get scared, right? We saw this in 2008 when similar things were happening. The ATMs almost ran out of money because of the collapse of credit and liquidity in the system. What the Federal Reserve was instituted to do was to create stability in the markets and to allow banks to have interchanging or interbank rates so they could lend money back and forth so that there was always liquidity in the system. So that's how it started out in 1913, and it's been working in that fashion, doing a couple different things since 1913. Let's take a look at how the Federal Reserve is structured here. Check it out. Right, the Federal Reserve, there's a chairman and a vice chair, and there's a board of directors. There are 7 members on the Federal Reserve's board of governors. These individuals are nominated by the president and approved by the U.S. Senate. Each governor serves a maximum of 14 years. Their appointment is staggered by 2 years to limit the power of each president. The purpose of doing this, the Federal Reserve was designed in a way to not be political, right? For the longest time, they met in secret and they kept the notes to their meeting in secret and wouldn't release them for a long time out. Why? Because they didn't want political influence coming in and talking more about that. But things changed, right? You see now Federal Reserve meetings always being broadcasted out where they're talking about what's happening. They're talking about interest rate rising. And for the longest time, let's say for the last 10, 11, 12 years, what they've been doing is lowering interest rates when really they probably should have been raising them up, right? Because we had a good long run, but every time they would creep that rate up a little bit, it would scare the markets would pull back, and people in the political system would scream and yell about what the Federal Reserve was doing, and it would tamper their intentions or what they were trying to do. The Federal Reserve was there and designed in this way so that political power was separate and they could operate somewhat independently, but that's been eroded away over time. Besides runs on the bank and making sure that banks are sustained and that there's security and financial trust in the system, what else was the Federal Reserve created for? Well, the stated goal of the Fed is to keep the economy healthy based on 2 criteria: minimizing unemployment and stabilizing inflation. The main tool they use to achieve this is by adjusting interest rates to the needs of the market. If we think back to the last few years, like I was talking about before, was the Federal Reserve really adjusting the interest rates to the need of the market? I would say probably not. They were holding interest rates down really low for a long time. What does that create? That creates a need for people to be in equities. Why? Because let's take a look at retirees. Retirees had nowhere else to go but to sit their money in the stock market because that was the only place to find yield. You didn't have CDs paying interest rates that were higher. You didn't have other opportunities for them to gain yield safely like you would have in past years when people were buying bonds. Interest rates are the hot topic. And why is that? Let's take a look here. Changing the interest rates. The Fed meets 8 times a year to discuss the health of the economy. If unemployment is high, they may lower interest rates in order to encourage more borrowing and business growth. If inflation is high, they may raise interest rates in order to preserve the value of money. But what does that also mean? By raising interest rates, businesses are less apt to borrow, meaning they're less apt to use other people's money to create and expand and grow. Why is this a problem? It starts to reduce the employment levels, right? So now you start to get higher unemployment. And when you have inflation and they're trying to combat inflation, if interest rates don't take care of all of it, well, what's the other alternative? Run the economy into a recession. So we've been talking about rate hikes and interest rates because it is a really hot topic. Right now, the Federal Reserve is meeting they've met throughout the year. Each meeting they've had this year, they've raised interest rates. So let's take a look at that. On Wednesday, September 21st, the Fed once again raised interest rates by 75 basis points. What's that mean? 3/4 of a point. This puts the current rate at 3 to 3.25%, with the markets predicting that the Fed rates ending calendar year 2022 at around 4 to 4.5%. As rates increase, people tend to borrow less, which causes markets to go down. What else does this cause, right? Let's take a look at it. They've committed to about 11 rate increases. So that would be 8 throughout this year plus another 3 next year. By raising those interest rates, mortgage rates start to climb. And as mortgage rates start to climb, what happens to housing? The value of the homes has to come down because the buyer pool gets so much smaller. So you saw, early this year or late last year, home prices increasing tremendously. And what happened now, because of the rate hikes and the staggering rate at which they're hiking rates, you're seeing that come down because now we're shifting from a seller's market into a buyer's market. One of the things that, the Federal Reserve was set to do that we didn't talk about was they really control monetary policy. And monetary policy, in my opinion, is there to combat poor fiscal policy, right? Fiscal policy is created by the US government, right? The senators and the congressmen. And because they write poor fiscal policy based on whatever they want to do for the political winds that are shifting, the idea was monetary policy could pull that back and keep them on a good track. But that doesn't always happen, and it seems to happen a lot less now, which is why you hear a lot of people calling for abolishing the Federal Reserve. I think if that is something that they want to happen or have happen, we need to think about, well, how do we make that happen? Let's not just get out there and scream about abolishing the Fed. Let's talk about what's a reasonable way to unwind that. But what's the best time to plant a tree? The best time to plant a tree was 20 years ago, and the second best time is today. So despite the period of rapid rate hikes and dramatic swings in stocks and real estate, dollar cost averaging has consistently proven itself to be the best investment strategy. Rather than timing the market, let your money spend time in the market. What this is really saying is that if you are investment oriented, you can't rely on what the Federal Reserve is going to do. You can't rely on what the US government's going to do. What you have to focus on is your own personal economy, right? And the idea of investing in a company and staying invested in that company, well, that's what Warren Buffett did, right? So if you do the due diligence, you really love a company, why not invest in it? And what does it matter if the stock price is up or down? The idea is to consistently be buying into these things, right? And that can work with anything. That can work with housing, right? If you understand housing, you like real estate, and that's what you want to buy into, those are things that you can do. The point of the matter is to really have your own ideas around what's going to happen, why it's happening, get a good understanding of that, and don't let fear or greed drive your market-based decisions just because you saw something on the news. If you've watched this far into the video, thank you, right? This Federal Reserve is not a exciting topic, but I know it's something that people are looking for answers on. They want to understand a little bit more. Appreciate you sitting through this. If you like this video, go ahead, give it a like. Share it to people that may also, want to know more about the Federal Reserve. And if you're looking to get a game plan, regardless of what the economy is doing, and you want to sit down with a team member from Epic, click the link below in the description, and one of the team members will reach out to you.